Okay. Uh, Good morning, everyone. Good morning, Professor Basu. Good morning, dear participants. So today, sir, can I start now?
Yeah, please go ahead. I'm there.
Okay. So, dear participants, so today we have reached the fifth and final day of the ongoing ATAL Academy sponsored 5 days advanced level online FDP on emerging financial management and accounting techniques. And today I feel very proud to present in front of all of you none other than Professor Sankarsan Basu of Indian Institute of Management, Bangalore. So, welcome, sir.
Thank you.
Sir, in this platform, we have around close to 100 participants. Uh, Gradually, I think they will be joining. Uh,
Mm-hmm.
I take this opportunity and I feel very proud to introduce to you Professor Sankarsan Basu, who is a professor of finance and accounting area in IIM Bangalore, which we proudly call IMB. He has been the chairperson of the postgraduate program in public policy and management between April 2017 and March 2019. The chairperson of Indian Development Colleges between April 2012 and March 2015, and chairperson of allied relations between January 2007 and September 2011 at IIM. Professor Basu is a BSc with honors in statistics from Presidency University, Calcutta, MSc in statistics from IIT Kanpur, a PhD from London School of Economics and Political Science, UK. His primary research and teaching interests are in the area of financial markets and quantitative finance, particularly derivatives and fixed income securities, and also insurance and pension issues.
Shankarsan Basu, please mute yourself.
Prior to joining IMB, Professor Basu has also worked with ICICI Limited, now ICICI Bank Limited, as well as been a teaching faculty at London School of Economics and Political Science, at Heriot-Watt University, Edinburgh, USA. Professor Basu has also been a visiting professor at University of Twente, Netherlands, Gothenburg University, Sweden, ESCP Paris, CVVG Ho Chi Minh City and Hanoi, Vietnam, and Asian Institute of Technology, Bangkok, to name a few. He is active in teaching, consulting both inside India as well as abroad, and also in research. He has published a number of papers, book chapters, as well as 2 books. He is very well traveled and has presented his works at a number of international conferences. And presently, he serves in the boards of a couple of companies. Sir also serves on the international selection panel of the selection of fellows of the German Chancellor Fellow, a fellowship run and administered by the Office of the German Chancellor. He is also a founder member of Indian Finance Association, IFA, and continues to serve as the secretary since the founding of IFA in 2015. He has also served in various roles within the Asia Pacific Risk and Insurance Association, including as president for the year 2014-15. So with these few words, I present in front of all of you, Professor Basu. Professor Basu, over to you, sir.
Thank you very much. Good morning, and I'm kind of honored to be here today to kind of talk to you all about derivatives and derivatives valuation. One challenge of doing this is that today pretty much everybody knows a lot about derivatives. So what new to talk about? So I'm really a bit confused in terms of what I can talk about. But anyway, I will try to use some of the material that I have, that I use at different points, to kind of talk to you all about both both valuing futures forwards as well as option contracts, and highlight some of the additional stuff that we kind of should be careful about in looking at all of these things. So without much delay, let me start. So let me start with the basic argument of What is a derivative? I'm not going to use slides for that, but I'm just going to kind of talk about that before I go into the futures of the forwards framework and all of that. And and then the whole logic of how do you kind of value that argument in that sense, right? So so basically, my first observation is that what is a derivative? And if you actually go and look at a derivative is nothing but a contract. It's simply a contract that you are valuing to take care of, to kind of price. So basically, it's nothing but a contract or an underlying. Like every other contract. Okay, let me just kind of try to use those slides. Let me just share my screen just 1 second. Okay, I hope you can see my screen.
Yes, sir.
Yes,
Okay,
sir. It is visible.
okay, good. So I'll just put this on full screen so that it becomes easier for everybody.
Yes, sir. It has become full screen now.
Yeah, okay. Okay. So as I said, fundamentally it is a security which whose value depends on more basic underlying variables. So at some level, there is nothing different from just valuing a security. I'm sorry, valuing a contract. Any contract, when you're valuing a contract, the contract value is obviously dependent on something else, and that is all that we are doing. What is the difference out here? The difference out here, that at some level, one could argue there is really no difference. And another way of saying there is a difference is to say what can be the kind of underlines and what are the implications of those underlines. But but at a very generic level, any contract is essentially a derivative security. There's only one small difference that typically comes in, and that is the only point that one needs to keep in mind when you're valuing a derivative security, derivative contract, which is the fact that the future value is uncertain. So it is basically based on a variable or a random variable or a factor whose future value is uncertain. What we know is the current value. Based on the current value and a host of other factors that we'll come to, you are trying to figure out, or you're trying to find out what the future value of that asset is going to be. And therefore, there is an uncertainty that comes in, which is what becomes the basis of the derivative framework. Because think of it the other way around. If I knew the future value exactly, so I mean, if the opposite of being the future value being uncertain is that the future value is certain. If the future value was certain, then there would be no difference in anybody's estimate of the future value, because there is a model which gives me the future value with certainty, which means all of us can look into that, all of us have access to that model, and therefore we will obviously, all of us would essentially use that argument to say, okay, what is the future value with probability 1? Once we know the future value with probability 1, there will be no rationale to do a transaction at any value other than that fixed that value that we're talking about. The fact that we are kind of not sure gives rise to the possibility of different values at which transactions can happen as more and more information comes into the system. Right? So that is what basically a derivative contract is. So therefore, when you look at, for example, in the equity market, when you look at a settlement cycle basis is not a derivative contract. Because if you think of it, a settlement cycle, there is no uncertainty in the future price. You have acquired it at the spot price. It is just an operational issue that the settlement of the same is not happening on the day that immediate. I mean, you could have a T+0 settlement also, but when it is not, there's only an operational issue that you are not getting it on that day. You are getting it 1, 2, 3 days later, depending on what your settlement cycle is. But there is no uncertainty in both price and ownership. In a derivative contract, that is where the difference comes in. Depending on the kind of the derivative contract that you enter into, irrespective of first, irrespective of what kind of derivative contract you enter into, the future value is uncertain. So there is no certainty about the future value. You can make some estimates of the future value and you play around with the estimates of the future value. And in some cases, even the potential ownership of it, whether you will actually have the future asset in the future, is itself a question mark, because under certain derivative contracts, you have the right not to, for example, in option contracts, you have the right of not to exercising the contract, and therefore future ownership can also be at stake. But when I say future ownership can be at stake, future ownership will not be at stake because of something else, but by your choice. I mean, this is one of the simplest examples that I can think of. This is the I'm going to really explain this. So actually, I could even drop the likely, and I could say an Indian exporter is to receive $1,000 after a month. I mean, just a very simple example. That is not even likely. The problem is that now the exporter believes that the dollar will actually, is not sure about how much the dollar value will be, and therefore contracts with the bank to sell the dollar at $80 or $80. One of the underlying fears could be that while the market kind of is ready to pay him $80 next month, he might believe that the dollar price will not go up to 80 or will come down and only be 75 or something like that. So this is a contract that if I run a contract like this can potentially give enhanced profits. So what kind of a contract do I use? There are different kinds of contracts, forwards and options, futures and all of that. That is another choice. Very quickly, this is what the history of derivatives is. I mean, there is a lot more history. One can kind of write volumes on that. But the earliest known product that we can kind of go back to is about 332 BC in Greece, when this guy Thales of Miletus basically speculated on olive harvest and therefore bought out the rights to all the olive presses. The underlying story out there was that in those days people didn't know how to preserve oil. The only way oil could be preserved is by converting it into oil, and olive oil could be preserved for a longer time. Therefore, in the and honestly, when you look at this becomes a pure speculative picture, because he expected it to kind of get a bumper harvest, and therefore the demand for oil presses would kind of go up. So he bought the rights over the oil presses. Now, obviously, he bought this before the oil press demand actually materialized. He bought it at an earlier point in time when he expected the harvest to be bumper. Now, what could have, in this case, it actually happened, so he made a lot of money in the process. Now, what could have also happened is that price of the harvest, which he thought would be a bumper harvest, was not a bumper harvest, was actually a very small harvest. For whatever reason, maybe for climatic conditions, for other reasons, it kind of crashed and had a very small harvest, in which case the demand for olive presses would not be there. In fact, the reverse would be there. The olive presses would kind of set up, or I would try to demand the farmer or the producer to kind of use their presses. So the investment in presses, olive presses, would obviously have gone bad. Right? So there was an uncertainty. In this case, this uncertainty came true, but it may not actually have come true in a different story. Now, since then, there have been a lot of cases of a lot of examples of option trades, of derivative trades that have happened over the next approximately 2,000 years or 2,000 plus years. But what we see, in some sense, the next main one that we saw was sometime around 1636, which was about 1900 years, about 2000 years, 1900 years after the first episode that we knew, was basically there were tulip options in the Netherlands. So that what was kind of called the Dutch tulip options. Now the problem with these are, these did not sustain for very long, and then you kind of added up and then with contracts died out, newer contracts came into place as we go along. In some sense, the organized structure started in 1859 with the establishment of the CBOT, the Chicago Board of Trade, where the first agricultural derivative contract was kind of set up, and CBOT continued to exist all the way for the next 150 years till in 1973 the sister establishment of CBOE, the Chicago Board of Options Exchange, was set up because that is when the Black-Scholes price came into being, and then using the Black-Scholes, that's how this kind of trade, this development, this option exchange came into place. Again, not to say that options were not traded before that, options were traded, options were priced, but what Black-Scholes did was Black-Scholes gave the first to kind of, Black-Scholes voted, to be precise, because they were independently, was the first to kind of show that how you could analytically and in a closed form manner solve the price of an option, solve for the price of an option, which gave a tremendous impetus and boost to the options market, and that kind of propelled the setting up of the Chicago Board of Options Exchange. Today, both the trades kind of happen, and it's kind of brought under the broader umbrella of so both derivative contracts in the futures format and an options format both exist, and then broadly brought under the umbrella of the Chicago Mercantile Exchange. So I'm going to skip this. Just to give you a quick idea, this is an old data, and I don't want to kind of really spend too much of time, but just to highlight the fact that derivative markets are there. The derivatives can be traded both on the OTC basis and the exchange traded basis. What happens is the whole set of products that you trade, if you look at the total set of products, under both sides, they are roughly the same and they kind of encompass everything that, again, broadly anything and everything that you can kind of think of in the financial market space. The only difference between the two is that the primary focus or the primary underlying that gets traded in the OTC market and the exchange rate markets are not the same. So, for example, the exchange rate markets, equity and equity stock, equity and equity related assets, equity index stocks kind of are comprise about 60. At that point comprise about 62%, and the numbers are very similar even today. But in the OTC market, it is predominantly interest rate, and this is also driven by the fact that what is your expected requirement, and that kind of drives the whole process in that sense. This is some kind of just because we are talking about in India. This is some kind of history of the development of derivatives in India. So actually, I should preface this by saying we actually had an active derivatives markets in the early part of the 1900s, till about 1951 or so. At least a futures market in the sense. And the Forward Contract Regulation Act of 1951 and the Securities Contract Regulation Act of 1952 actively went about stopping those markets at that point. We didn't have an options market in that sense, but we actually had the futures market in place. But the Government of India, on agricultural commodities, the Government of India actively went in and stopped these markets, and therefore for the next 50 odd years, you did not really have a market development happen. However, in the 80s, you had currency forwards, swaps, and all that started coming in, which was bilateral, predominantly interbank and all of that, so that kind of started coming into play. On the other hand, the exchange rate thing in India starts with the report of the L.C. Gupta Committee in 1998 and 1999, and effectively the whole process starts in June 2000, and then it is kind of an evolving story that we kind of see. This again, all of us know, but the only thing is there's only one point I would like to highlight, which is if you look at the, I don't want to really go through the whole slide because after all we have limited time, but I just want to highlight one slide, one point in the slide, which is if you look at the underlying, there is a reason as to why I have differentiated between financial assets and financial prices. And the reason is that financial assets are like physical commodities. They are what would be termed as real assets. So financial assets are equivalently real assets. It's exactly similar to your physical assets. And the simple way of thinking of that is those are assets which on settlement or at the time of settlement can actually be put up physically for delivery. So you can actually physically deliver them. That is what a financial asset is. On the other hand, financial prices are not physical assets. They are what we would term as notional assets. And therefore, you cannot physically use them to settle contracts or anything. The only way you can settle financial contracts or notional assets in particular financial crisis, but could be any other notional assets, because the lower half is also essentially all notional assets, is by equating it to some asset which is then payable, which is liquid enough, which is divisible enough, and all of that, which can be used to settle the contract. Now, the most common asset against which it can be done, and it is done, is money. So obviously, the idea is the payoff is monetized against some benchmarks or some framework that you kind of create. So, for example, when you do an interest rate contract, and if you at the end of the day, you let's say you get a proposition where you say that you benefited by 10% interest, but 10% interest means nothing in any scenario unless it is linked up to a principal, unless it is linked up to a time horizon. Because for the same 10%, depending on the principal and depending on the time horizon, the actual values could actually be different. So necessarily, therefore, while you are still playing on the underlying, which is the interest rate, but the settlement will actually have to be done using a physical settlement model. That's the primary difference between notional assets and real assets or physical assets. Now, if you look at some of the other ones, credit, weather, emission, these are all notional assets, because fundamental credit then credit is also notional assets, because you can't obviously credit derivative is an insurance against the credit worthiness of an instrument. So if an instrument defaults, there is no point you can give that back. So either you will actually have to give cash or you will give a different security. That the different security is possible, but that is what you can kind of do in that sense. Emission is on carbon credits and all of that. That's kind of happened, and that used to be a very active market in the late 90s and early 2000s. It went down significantly after that. It is just about starting to revive. And then again, some of these things come nothing from the financial market, but emission is a classic example which does not come from the financial market but does give you a financial product. And that is basically the logic of, so how did the emission come into the picture? So if some of you may remember that way back in 1994, actually 1992 followed, but it's kind of decided in 1994, they had the world witnessed what was called as a Rio Summit. The Rio Summit was like the COP21 Paris a few years back, or the COP26 in Glasgow, the conference of parties on climate that happened in Glasgow last year. So there was something called the real first, probably the earliest, one of the earliest ones, but definitely one of the most famous ones, was the Rio Summit of 1994. And under the Rio Summit of 1994, one of the understanding that was entered into was to kind of look at this. So basically, they said that, okay, because of this environmental issue and all, we will control, the world will came to an agreement that the total amount of greenhouse gases that the world emits should be controlled and should kind of be managed. So it was a good understanding, and then what that translated to is that every country got a certain amount of quota, so to speak, quota from the overall system as how much of greenhouse gases they could emit into the system. And these became a function. So the amount of greenhouse gases a country could emit became a function of a few things, which included population, size of the country, level of development. I think these are the three main ones that kind of came in. Now, the problem was that, and if you actually looked at all of that, countries like USA, Northern European developed countries, were literally at the top of the pile, so they really were already kind of emitting the maximum they were supposed to. And the idea was that they being developed, having the resources, will actually be able to, do technical development so that they could kind of better their processes and overall improve the system. Countries like India, China, Brazil got a lot more credits than they were actually consuming at that point because of the land mass, population, development, and all of that. Now with this, really showed while the letter of the law, which was the total greenhouse gases emission should need to be curtailed or be constant, that was maintained. The spirit of the law was kind of completely thrown away, because that is where investment bankers came in and said, okay, they came into governments in Brazil, China, India, Indonesia, and all of that. had excess carbon credits and said, look, you have excess carbon credits which you are not using. Let's trade on that. On the other hand, US, for example, had a choice. They could either invest in development and therefore reduce the carbon credits, or they could say, okay, we'll hold the carbon credits and then buy for the additional amount that we are emitting, we will simply buy out somebody else's carbon credits. And then therefore the total emission numbers would still be good. But the problem is that the spirit of the law, which should have been an overall development of the market, technology space, and all of that, did not really happen. So that kind of created a market that became a very active market because one could monetize it and one got away with it. The world, and that saw a significant jump in all of this till sometime, as I said, about 2004 or so, at which point the US government under President George Bush decided to unilaterally withdraw from the Kyoto Protocol. So the Rio Summit went into the Kyoto Protocol and it was formalized, and they kind of withdrew from the Kyoto Protocol. And basically, US government said, we do not give any sanction to these numbers, we don't care, we are not going to follow it. What happened in the process? The moment US government walked out of the equation, the largest country with the largest demand, so all the largest players in the system actually went out of the system. The size of the system obviously had a huge impact, and in some sense the system collapsed. And for years after that, for the next 16 odd years, the market existed in a very small manner in Scandinavian countries, in Germany, and then some parts, France, and all of that. It's only of late that the whole discussion has restarted, and there is a great importance and impact of such products. I think also fueled by the fact that you have climate finance, you have ESG, and all of that has come in over the last couple of years, and that is again kind of rekindled the demand in these markets. Okay, so as I said, OTC and exchange, all of us know this. Just a quick point on this slide before I go on to valuation, looking at forex, looking at futures and forwards. The world, whatever we say and do, the world only has two kinds of derivative contracts. You either have a forward contract or you have an option contract. There is nothing else. Anything else that you have is a variant of these, a combination of these, or sort of market conditions and regulatory conditions that are imposed on some product like this. The best example is the futures contract, because in a futures contract you realize that a futures contract is exactly the same as a forward contract, except that the futures contract trades on an exchange and therefore is bound by the conditions of an exchange in terms of bankruptcy, default, and all of that. On the other hand, a forward contract is basically a bilateral agreement between two counterparties. So some of these things don't really matter. But apart from this, the product works exactly in the same way as a forward contract. So whether you start from forward to futures or futures to forward, you're exactly at the same place. The primary issue of it is that in both these cases, you are guaranteeing an exercise, and therefore you do not know whether the exercise you will make money or lose money. But once you enter into it, a forward contract or a futures contract, you are guaranteeing exercise, and therefore you will have to exercise even if you lose money. And that's kind of legally binding. Obviously, you don't want to, given everything, you will not want to exercise when you have a choice, and that choice is essentially what comes in from your option contract. So in an option contract, you fundamentally have the choice, but not the obligation to exercise the option. And then therefore national expectations would argue that you will not exercise the option if you are making money. Sorry, if you are losing money. So if you are out of the money, if you are losing money, you should not rationally exercise the option. And therefore the option holder really has the chance of looking at it. Anything else that I have below that, compound derivatives, structured products, exotic products, anything else that one can talk about is nothing but a variant, combination, some kind of a portfolio mix of a forward-like contract and an option contract. Broadly, these are what it is: forward contracts, futures. So broadly, if you look at it, futures are by definition explicitly exchange traded. Options can be exchange traded or OTC. Others, I mean, swaps is also nothing but a series of forward contracts. So therefore, they are all fundamentally OTC contracts. How are derivatives used? And this is relevant because before you look at valuation, one should kind of spend a little bit of this. How are derivatives used? Well, fundamentally derivatives are used. That is what a regulator would want you to do to hedge price risk and any kind of risk. But I also argue on the other side because, and then therefore I have the second point. The others are kind of straightforward, but therefore I have the second point, which is essentially the whole argument that you also can use it for speculation. Now, in a broader context, and that also applies here, so it is not as if it only applies in a broad context, but it applies also equally here, is the fact that, if what is risk reduction? What is risk? What is a hedge? We need to understand what is a hedge and what do we mean by a hedge. A hedge does not automatically imply risk reduction. Right? Risk management does not automatically imply a risk reduction. It is in some sense it is actually a risk redistribution. Because by hedging, what are you doing? You have a certain risk which you think is not acceptable to you. I believe that that's an acceptable risk. So we trade off on this. So you sell off the risk to me for a certain consideration, and then that's what it happens. And therefore, your risk goes down, my risk goes up, and we are okay with that. As long as I believe I'm okay with that. Right? So so therefore, in a more larger context, one can argue that for a risk management process to exist or for hedgers to exist, there needs to be speculators in the market. You can't have a market of only hedgers, you need to have hedgers and speculators. What else can you do? You can lock in arbitrage profits, you can change the nature of assets and liabilities. What is the whole point of nature and assets and liabilities? Basically, without selling down the portfolio. Obviously, you can, if you have a fixed rate asset and you want a floating rate asset, one choice that you always will have is you can sell down your fixed rate asset and buy back the floating rate asset. Now, there are a variety of reasons in practice as to why this may not be feasible, this may not be doable. And that is where derivative contracts actually come handier and helpful. So, okay, let me. So these are standard stuff. So I'm not going to kind of let me move on. Okay. Right. So let me move on to futures markets. So what I've done out here is that I have given you all some links where the specifications of the futures market of a given contract are defined. Now, why do I need this? Because on an exchange, you need to kind of define a lot of things to make it standardized. Realize that the deal on the exchange is a standardized structure. If I did not have the exchange, I could have dealt directly. Right? So these are basically specifications that you see on all of contracts. What is the minimum tick size? What is the settlement process and all of that? That kind of shows up on all of this. Specifically with respect to index futures contracts, and this is relevant. This is also useful because we are one of the largest derivatives markets in the world. In fact, NSE, I was reading yesterday or day before, has been tagged as the largest derivatives exchange in the world. Obviously by volume, not by value, because of the exchange rate. But by volume, again, we used to be one at some point in time. Then for some point in between, we became, we always were top 3 or top 4. And I read recently, yesterday or day before, that we are back to having the number 1 spot. Typically, a futures contract is nothing but a forward contract, but with conditions of the exchange put in place on top of it. And these conditions are with respect to various contractual features that you have market organization, who are the participants, and the outcome profile of gains and losses that come in. Now, the major features are these. The primary point that comes in a futures market is the presence of the margin account, or the presence of margins. And I'll just talk about margins in a second, but the presence of margins and, in some sense, the standardization. Now, when you talk about financial assets, and this goes back to valuation of the asset itself, when you have financial assets and things like that, you probably do not have to worry in terms of the standardization argument. Because as long as you have the same asset, all shares, all bonds of the same asset at pari passu, or in other words, one would argue that all are equal, rights all are equal. But if you do agricultural commodities, if you do some of the commodities, it is not necessary that the asset is going to be a standardized structure. What you want to deliver and what you actually have for delivery may not match, and it may be both ways. Right. So therefore, that is where the contract, the standardization needs to be done. Because obviously, take a simple example: you enter a rice futures contract. Now you enter into the contract where rice is sold. By the time the rice is harvested, the quality of rice is only known when the rice is harvested. You've already entered into a contract to deliver a certain kind of rice. And if you have a better quality rice, you would want a standardization, even in terms of volume or in terms of price, to help you to kind of offset the better, to kind of make sure that when you're doing better quality rice, you are not being shortchanged because you are balancing it out against what. Or if it was not, what amount you would have given and an equivalent amount. Similarly, if the quality is lower than what you promised, you have to kind of compensate in some manner, which could be a physical compensation, which could be a cash compensation or whatever. So that also has to be kind of accounted for in that fashion. Now, typically, a futures contract will have all of this, the asset, contract size, delivery arrangements. So now, in general, here, and this is something that I'll show you in a minute about the financial assets, because the investment and consumption assets that kind of make a difference. Now, in financial assets, generally well defined, and therefore, as I said, no specification is required. However, in the case of commodities, there is variation in the quality that is available, and therefore, one would need to define what are the acceptable rates. That's what the exchange will actually have to do. So, what is the band in which, if you fall within the band, you want one particular point, but obviously you may not get that point. So, what is the range? What is the band in which, if you fall, it will be kind of acceptable in that process? Right? Now, there's also this thing that you have to be careful about, that if the size is too large, or is the size too large, or is the size too small? Because if the size is too large, the small investors will not be able to come into the market. Think of the bond market. The bond market, the minimum bid size is 5 crores, which obviously therefore inhibits small retail investors from coming into the bond market. Now, there may be 101 reasons on the other side as to why so if the size is too large, small investors will not be able to come in. If the size is too small, large investors will not want to come in because the transaction costs become too high. So it's a trade-off in between that kind of happens, and therefore a lot of exchanges have introduced mini contracts that was there. So this India index of stock futures have a contract value of 5 lakhs. So futures market lot is 50, and then I just put some data out there. So this was what it was. This is just an indication of what the prices were. Now, delivery. So typically, in financial assets, most of them are cash settled, so therefore delivery is not a problem. However, for commodities, and if you choose, you may choose. A lot of people don't. A lot of people simply take cash delivery. But there is a possibility that within, I think, 5 days prior to maturity, there is a window in which you can decide to take physical delivery. And that becomes important because, the trade may happen on an exchange. The counterparties may be based complete because today everything is online, electronic. Counterparties don't need to be there. So therefore, there might be significant transportation costs involved in kind of the delivery process. And particularly if alternate delivery locations are chosen, the price, because of this alternate delivery location, has to be adjusted based on the location chosen by the short position, very short. As I said, in financial futures, generally settlements are done or financial futures generally are all cash settled, and therefore there is no question of a delivery. But traders will have to choose to close out their positions. So most traders choose to close out their positions, so do a cash settlement and get out of it. Why do we have limits? Well, concentration risk and volatility. So price limits are there to kind of prevent volatility or very high levels of volatility. There is a question that can be asked, is that a good or a bad idea? But that is what it is taken to be. And on the other hand, position limits are taken to kind of avoid concentration risk. What's a closeout? A closeout is essentially you enter into an offset contract or a reverse contract which mature to the one that you have the original contract. Maturity of the contract has to be on the same day as the original contract. So in one contract you buy, in another contract you sell. Therefore, when you buy or sell the same amount, therefore the payout, the physical payout part gets cancelled. The differential amount in terms of the price or the buy price and the sell price is all that matters. So therefore the process can easily kind of continue. Now this is also true that if you take over a period of time, the futures and the spot price will have to converge. That this is true of forward prices also, but this will always happen because today what is the futures price of an asset today? It's always a spot price because today what's the zero period forward price or zero period futures price? It is always going to be the spot price. And therefore, initially there might be a deviation where the divergence is because there is a difference in expectation, but as we go forward, these will actually have to match. Now the problem here is, and this is the challenge that we don't see as a solution. So the problem here is, which leads what? Does futures lead the spot? Does spot lead the futures? And I don't have an answer. I don't think anybody has an answer. In a given circumstance, in a given framework, for a given product, you may have futures leading the spot or spot leading the futures. So both are possible. What is not possible is both being possible at the same time. But fundamentally, otherwise, both are possible. Right? And also, this can be different for different assets, different markets, and different time points. So there is nothing common. It is not as if a given asset will always have the futures price leading the spot, or in the other case, the spot leading the futures. It is always at a given point in time for a given asset in a given market. You change any of those conditions, the story may actually undergo change. We also know we have this margin process. So there is two types of margins that get collected. There is a trader margin, which is collected by a member from a trader, and the clearing margin, which the exchange collects from the clearing member. So what's the trading margin? It's basically the security that you keep with the broker, but after the broker does the trade on your behalf. So what if you do not honor the trade after the trade has been done? So the margin is kind of the protection that the broker takes, so that if you do not honor the contract, they actually are safe because they have the margin balance. Now the second line is actually important because in a futures market contract, the exchange or the clearing house keeps the margin, and because they are a non-interested counterparty, they can easily keep the margin, and therefore there is a daily settlement, and therefore to reduce their risk, they kind of do a daily settlement of the mark-to-market, or what is called the mark-to-market. So daily settlement of the margin through what is called as the mark-to-market. What is mark to market? Mark to market is basically saying if I had a portfolio and if I hypothetically sold it down today, what would be the benefit that I would get? What is the profit or loss that would get generated from that transaction? It does not mean I'm selling it down, it is only a hypothetical process. Now, in a forward contract, this is not possible because there are two counterparties in a forward contract, or a little bit more counterparties, but every counterparty is what would be equated to being an interested counterparty. So, therefore, the possibility of the counterparty being non-interested does exist. And how does it affect me? It affects me because if one of the counterparties were to keep the margin account, margin balance, what will happen is, if that counterparty defaults, not only is the counterparty defaulting on his or her future obligations, but is also defaulting on the balance of the margin account, which inherently was not his or hers, was the counterparty. It was just maintained by this counterparty and hence it kind of stayed there. So obviously the credit risk increases. Nobody would want the credit risk to really increase and an increased loss of money, which is where forward contracts do not really have margin accounts. It's only futures with contracts that have margin accounts. Now, in terms of margin, these are you have a margin account. You start off with an initial margin, and then you have a daily set. So on a daily basis, you are marking the market and you are doing a daily settlement. So, which means that the profit or loss is credited or debited to the margin account balance. Now, there is a minimum balance that you need to keep, which is called the maintenance margin. In the event the balance in your margin account falls below the maintenance margin, a margin call is initiated, which is nothing but the bank or the clearinghouse or whoever is running this raises an additional request for additional cash. Right? Raises a request for additional cash within a certain time horizon. If the cash is paid, typically the margin will then go back at least above the maintenance margin, and in some cases it might even go above the initial margin or some threshold margin. And if that at the moment that happens, trading on the process starts again. In the eventuality that after the margin call somebody doesn't pay up, that is when the exchange will enter the process, shut down the contract, pay out the counterparty who has not defaulted, and first treat the counterparty who has not paid the margin of the defaulter, close out the position in the market, close out the underlying position in the market, and pay out the non-defaulting member in full, so the non-defaulting member does not lose. The advantage of this is, see, if there is a margin call and subsequently a default happens today, which means still yesterday all accounts and everything was kind of squared up, so there was no default yesterday. So the default is happening because of the incremental loss today. Now, if you started today, you would at least have the right? So that is the max. So maximum loss is essentially only the loss on that day. Now obviously there is some margin balance that is there, so the exchange will first take over the margin balance, and therefore the actual loss the exchange suffers is the amount of loss in a given day in excess of the margin balance that existed. This is obviously going to be lesser than the total loss, and to that extent the exchange kind of protects itself, and that's the reason for doing this. What is variation margin? The last point. Variation margin is, as you change as the accounts, margin accounts gets credited and debited, and if it falls below the threshold and therefore a margin call is raised, these additional cash flows that have to be made that are just adjusted are what are referred to as the variation margin. Well, I did have an example out here, but okay, I'll very quickly show you. So I have a futures price of 1060, contract size, and I want to write 1000 shares, which means I need to buy 2 contracts. And there's a margin condition that is there, 20,000 per contract to 40,000 in all. At the end of the day, it is going to be adjusted. The daily mark to market is going to happen, and the daily settlement is going to get reflected in the trader's account. And there is a threshold margin of, they also set a threshold margin of 15,000 per contract or 30,000. What happens? And obviously, if it falls, there's a margin call that will happen. So this is that's closer, but let me show you the table out here. So if you look at out here, 1,000 stock futures are bought at 1,060 and sold at 1,020 on the other day. So you bought it now you see on a daily basis the settlement price goes up or goes down, your daily gain or loss kind of happens. You started your margin account with a balance of 40,000 for two contracts. So when you gain 5,000, that kind of gets reflected in terms of, so you get 5 and then on 1,000 stocks, you get 5,000. That's then your balance goes to 45,000. The next day, as you can see, there is a significant price drop, which has caused a huge loss, but most importantly, the margin balance has fallen below the threshold. Right? Now, wherever you can see this, the one place where at the start, what does it imply? And there is also at the lower end, what will happen? Those places where my balance is kind of gone below the threshold margin, and therefore I have to put in additional amount of money. Now, in this case, I put in 18,900, and therefore I've brought it back to 4,000, about 40,000 again. But the threshold was 30,000, so I could have got away with 8,900 also. But just to at the very least, just I could put in anything more than that, and that's exactly what has happened. And therefore, in December 20, when you sell it off, your margin balance is 43,650. That is released. So that is released to the counterparty, and whoever for whose margin side you are looking at, and that person has the balance is now the balance, whatever is the balance in the account, is that person's money, and after all, it was his money who had put it in, so the money is kind of returned. Sometimes margin accounts do pay some marginal interest also, but that's not necessarily guaranteed. This is essentially the working of that in the whole process. Okay, and also we have the exchange clearing house, which is essentially the entity which does all of this, because it guarantees the performance of each of the parties to each of the parties to the transaction, and therefore brokers who are not direct members of the clearing house are not going to be subject or will not be managed by. Will have to be managed, and therefore they cannot be kind of accessing the markets by themselves. Right? Now, obviously, the main task of the clearing house is to kind of keep track of all accounts and stuff like that, transactions, and basically maintain records in and out of each of its members. Okay. Yeah. So there's also one other thing that happens, which is there is a gross and a net argument. So are you kind of taking it in the gross basis? The problem of the gross basis is that you're actually adding all the long and the short positions, and you are giving up inherent value, inherent benefits that exist because they may have gone, the client may have gone long on some contracts, and with somebody else may have gone short. So that there is obviously, if you count them separately, they may actually be a huge amount, a huge inflation effect coming in, and double counting in some sense happening. So a lot of people and a lot of exchanges have moved into net trading on a net basis, basically to ensure what is the effective exposure that you have. And you have OI, open interest, is the total number of contracts outstanding, and that is nothing but either the total number of long positions or the total number of short positions. It's going to be a settlement price, you can fix a time, and the volume of trade, number of trades in a given day. Now, as I said, most financial futures are stock or cash settled, which is basically what the contract is marked to market on the last day, and the positions are declared closed. The settlement price on the last day is the closing spot price on the underlying. I've already talked about this, so let me kind of skip this and quickly talk about the forward contract. Okay, now one of the things that you have to be careful about, and then this will kind of show you the valuation also in a sense. So with that background, now you can have. So what? Okay, just before 1 second before I do this. So what I'm trying to do is I'm trying to use this session for the next half an hour finish off the forwards part of it, so that in the second session from starting at 11:45, I can then show you and talk about a little bit on the option valuation part. Right? Now, so any asset can be kind of classified as investment assets or consumption assets. The basic definition is that investment assets are held by people purely for investment purposes. I know there are differences when that will show up, but we will talk about that in a second. Consumption assets are held primarily for consumption. Now this is also true that a lot of assets that we classify as investment assets, silver, I mean a lot of precious metals and all of that, also have a significant usage or significant demand in the industry. But what we argue is that a fair number of people hold these purely for investment purposes, and therefore these would effectively be considered as investment assets. Now, why do we classify? Why are we differentiating between the two? The reason we are differentiating between the two is because and I'm going to use forward and futures interchangeably because, as I have already said, it is exactly the same thing. The point is that arbitrage, I can fall back on arbitrage assumptions or arbitrage arguments. Essentially, the fact that the market should not have arbitrage, or more importantly, I cannot design something which will create an arbitrage to kind of value investment assets. But for consumption assets, that's not possible. Now, just before I highlight that, just to kind of also give you the thing, what is arbitrage? We all know arbitrage is nothing but risk-based profit. Now, when I say arbitrage, when I use arbitrage argument, why does arbitrage exist? Arbitrage exists because of market inefficiency, asymmetry of information, market inefficiency, some problem in the system, some gap, could be regulatory differences which are not addressable. That is why it leads to an arbitrage. An arbitrage has a few features. The first feature is that, as I said, as long as markets are imperfect, possibly arbitrage exists. What is the strategy that one has to find out? If there will be a strategy, but the question is, what is the strategy is something one needs to find out. The second point is that there may not be, while there will be an arbitrage profit under certain assumptions, but that profit may not be huge. So some of the standard assumptions that we make are no transaction costs and stuff like that. Now, you may have a very marginal profit, and in practice there is transaction costs and all of that. So if you add that together, the arbitrage profit may not exist. So therefore, you may not exercise the strategy to get the arbitrage profit. But arbitrage as a process will obviously continue to exist. Obviously, the other argument in that is you cannot design a contract which will create arbitrage, because then you are perpetuating and increasing the market inefficiency. So fundamentally, you cannot design a contract to perpetuate arbitrage, which is why we assume that there will be we want to argue that there will be no arbitrage. Even if there is a possibility of an arbitrage, right? So that's what we use. But consumption assets, this is not possible. There's some very standard assumptions. Now you can obviously question some of them, but these are the simple assumptions that come in. No transaction costs. This is very typical economics assumptions. Same tax rate on all trading profits. But the third one is actually the real bug of all of it. That we are borrowing and lending. There's only one interest rate in the market, and it is same for everybody. So effectively, you can borrow and lend at the same rate. Now that does not happen in practice. There is a spread that has to be adjusted for. Market. Now, while on one hand, at the last point, under equilibrium, there will be no arbitrage pricing, which is correct. But given that markets are inefficient, markets are not necessarily in equilibrium, there could be opportunities to take advantage of arbitrage. And as and when arbitrage opportunities arise, if they are spotted, they will be taken advantage of. So look at this. If I want to look at this, Okay. Actually, I cannot. I mean, while I can see my screen, but for some reason I cannot see any of you all. So, is there any questions or observations that you want, that you have, the comments that you want to make?
Dear participants, if you have any query at this point of time, Professor Basu is asking.
So for some reason on my screen, I can only see the presentation and I can see a small bar saying the screen is sharing. But I can't see any of you all or any questions.
Professor, good morning, Professor. I am
Yeah.
Sasi Kumar from Hyderabad.
Let me do one. Let me just stop sharing for a second and then I'll start back again. Yeah.
Good morning,
Yeah.
Professor.
Yes.
Professor, my small observation in the derivatives market. Once upon a time, we witnessed about the physical deliveries. And
Yes.
slowly it was shaded away from the market, and now we are in the moment of quick transformation of futures and spot prices. Recently, when we witnessed in the market about the gap between these two was quickly evaporating. So is it maybe because of the pandemic or any other specific reasons
I
for
think
this?
pandemic I don't think has any role to play in that process. I mean,
Because especially in the index futures, I observed about it, the gap was quickly evaporating in the market. Example like the premium gaps.
which basically implies that the markets are getting more streamlined. So there was a gap that was happening because of, see, physical delivery led to inefficiencies in the system. We've kind of tried to move away from physical deliveries. Even in the I mean, index you can't do a physical delivery, right?
No, not index. My question is two parts. I'll divide it into two parts. Uh, in few years back, it was about the topic of physical delivery of few commodities to reduce about the volatility or whatever may be the
True,
factors.
true,
But
true,
over
true.
a period of time, that was not an issue in the market. This is my first question.
Yeah.
Second one is about uh, especially during the last week and last before week, while I start investing in the index based futures, what had happened, the premiums that are supposed to build up in the index, the premiums that are quickly evaporating, and over a period of time the premiums are quickly converging about a few positions, especially like call and put positions in the index. So it may be because I don't think so the pandemic is already a factor in the
No,
market.
see, I
Any
think
other?
I'll give you the answer to the first question is this, is that, or my reaction to the first question is, yes, you had, as you rightly said, a few years back, about 5, 6 years back, there was this whole push in the commodities market towards kind of having a physical settlement process put in place. In fact, we had a model where we said that you could take a physical delivery, you just had to announce 5 days in 5 or 7 days in advance, and then you could. But what that led to was, what people realized and what it was figured, that what that led to was actually a fair amount of confusion in the whole system, and unnecessary speculation was kind of getting created, because there was an initial level of speculation that started getting created in the market, which was, will you take physical delivery or will you take cash settlement? Not necessarily on the underlying asset, but I'm now creating another another offshoot, which is, I'm now trying to bet on the fact, will you take physical delivery, will you take, so because if you take physical delivery, then I will have to arrange for it as a writer or as a seller on the other side.
Yeah, yeah,
So therefore, it is not just on the underlying product that I'm playing on, but I'm also playing on your thing. Now that led to another additional level of speculative activity that in the process. The regulator, and particularly a lot of this was on agri futures.
yeah,
Not so much on the non-agri futures, a lot of it was on agri futures. Agri futures, the government in India is very, very sensitive, because, and I believe it's wrongly so, but the government tends to believe, and I'll tell you why I believe it's wrongly so, but the government tends to believe that, agri futures trades have a significant impact in the volatility and therefore the volatility of these underlying assets, which leads to a significant increase in the inflation. So they're very, I mean, any political system is going to be sensitive to inflation, and therefore, if that is their belief is that inflation is linked to this trade, and therefore they kind of, react in that manner. So that's kind of, but that's kind of unfair, because if you go back and look into the Abhijit Sen committee report of 2007-2008, when for the first time they banned agri futures in India, the American committee very clearly says that it is not because of derivative or futures trading activity, it is because of other problems which included your lack of go downs, the supply. It was not about the demand side problem, it was more about the supply side problem. And that problem has not been resolved. So when they did this, that got created once again. So they did not. So obviously they wanted to kind of avoid that, and they kind of moved away from that in that sense. So that's one of the things that happened, and that is why that kind of died out after some point in time. Obviously, there is this other challenge that typically happens in a country like India that becomes an even more problem, because you think of it. For example, who's one of the largest buyers of wheat on an organized manner? ITC.
Yeah, ITC is only the player. That too, they are engaged in the forward. Majority of them in
No,
the
that's
FRAs only. Forward rate agreement.
yeah, I'm telling you, but think of it this way. The major buyer is ITC, one of the major buyers. There are a few others also, but one of the major buyers is ITC.
ITC.
If you actually look at the ITC factories are all, around in and around Andhra and kind of south of the country. Yeah. Most of the factories. The cigarette factories are up north, but most of the other factories that they set up in afterwards, and this has got nothing to do with futures, by the way, nothing to do with derivatives, but the reality is, and then we cannot disassociate reality, they're all in somewhere in the Bhadrachalam and in that belt, by and large, where agri products are needed. The primary source of production of wheat is up in the north. Your primary wheat mandis are in Punjab and Haryana. Yeah. Now, if I take it there, which is why they landed up into forward contracts and they kind of negotiated prices and all that. Because if I land up going there and taking it, then what happens to my transportation costs? Suddenly my costs kind of spiral, and there are other factors that I have to kind of deal with. So they tried. So all of these things also impacted the whole process in India. Not everything was purely market, right? Yeah. So that's the first one. The second question that you had about this diminishing premium and all that, I think, and I mean, particularly if you see around the third week or the last week of the month, it is also linked with one interesting thing, which is what is the expiry date of the futures contract in India? Yeah. If you look at the expiry date of the futures contract in India, it's a very interesting, I mean, it has to be on 1 day. By definition, futures contract has to be on 1 day, so there's nothing new that I'm talking about. But the interesting thing is that it is defined to be on the last Thursday. Sorry, it is defined. Not last Thursday. I'm sorry. It is defined as a Thursday preceding the last Friday of the month. For some strange reason, it is defined not as the last Thursday or the last Friday, but it is defined as last Thursday. Thursday preceding the last Friday of the month. What does it mean? What it means is that in most cases, if the month ends on any other day but a Thursday, it will be the last Thursday of the month, and therefore it will be the last week. Yes. However, if the month ends on a Thursday, which I think happened 1-2 months back or somewhere. Yes. November, I think it happened. Yes. What happened is, therefore, the futures contract expired the previous Thursday. So 7 days before the end of the month. Okay. So, for example, if 30th November was a Thursday, I can't remember, I know one of the months happened recently. If 30th November was a Thursday, the expiry of the futures contract will not be the 30th of the month. It will then be the 23rd of the month. Yes. That means it's a good 1 week price, which is why you're also getting the third week phenomenon, not the last week phenomenon. And what happens is, liquidity is the highest of that contract. And, in India, we typically have 3 contracts in the market. You have a near-month contract. It's basically all contracts are 3-month contracts. Therefore, they end up at any point there's a near-month contract which expires immediately, a mid-month, which is next month, and a far-month, which is 2-3 months down the line. Yeah, as the contract expires, a new far-month contract comes into play. Now, the liquidity on the near-month contract is the highest. And as you get to, and that's very simple. The reason why the liquidity on the near-month contract is highest, and increase also as you get towards the settlement date, the expiry date, is because the uncertainty that I was talking about to start with, the uncertainty between the futures price and the spot price reduces, because you are kind of getting to a convergence. A convergence graph comes in, whichever way the convergence happens. Yeah. So the liquidity kind of increases, which is what, if liquidity increases, what happens? The bid-ask spread reduces, Why is there a bid ask? Bid ask is there because of market inefficiency. Reduction in bid ask is essentially translating to an increase in, at least, I do not want to make a generic statement, but in the short term, an increase, at least at that point, and for that period, an increase in the market efficiency,
Sure.
which is exactly why you are seeing this additional premium that you could get, kind of reducing, and people, and some people who are still speculative and want to take a risk position is wanting to move into a call or a put position depending on what their view is. But fundamentally, the market premium is decreasing because of an increased liquidity, which is kind of increasing the efficiency of the system.
Yeah, my small extension, and sorry to
Well,
the reason to ask this question is very simple. Once in the market, I used to play with the naked positions, but over a period of time, my observation, due to the market swings, I used to play with covered positions, especially the recent index movement. I used to take up both call and put in such a manner that the call premiums are exhausting quickly, but the put premiums was not moving in the direction. That's where exactly I got it out. Now the market was slowly moved from stock to index, because almost the stock based selections not dominating today.
no, that is true, but that, see, again, it is. I mean, my response to your position argument would be that it is also a function of your risk appetite. You have a certain amount of risk appetite, and it's a function of your risk appetite that you are kind of looking at, and that is why you are playing with. I mean, you played with naked positions at some point. You've now moved into taking a covered position because your risk appetite has changed. Somebody else may have a different risk appetite, and that may still continue to hold in that fashion. So there is very little that one can comment on that.
Sure, sir. Thank you, sir. Thank you for really.
Okay. Anybody else? Any others?
Sir, I have a little question.
Please.
I am Dr. Dipesh Mahajan.
Please go ahead.
Do you believe that really market discounts everything?
Market discounts most of the things.
That means future course of action or the economic events?
See, market is one of the best judges. Now, can we, in any form, can we get a perfect market? We are moving towards it. But, this definition is of perfect market is an elusive definition. I don't think anybody has a clear eye. So we don't know what the goal is. But incrementally we are improving in the processes. And initially we may have done by leaps and bounds. Today we are doing incremental increases. So market does have some indication. Sometimes it gets it right, sometimes it gets it wrong, but does have some indication based on, and then it's very difficult to pinpoint it down to a single observation or something. But there is something that the market obviously, does. So you could argue that essentially means that there are leakages in the system, which there is. I'll give you a different example outside this. You see, when there is now you have rating agencies, right? Now, what is the role of the rating agency? The role of the rating agency is to kind of do the ratings and all, but fundamentally tell people that this company is doing well or this company, the debt is gone over. And therefore, only when the rating agency announces it in a perfect world, only when the rating agency announces it, should the market react?
No.
As in a perfect world.
Yeah.
In a perfect world, only when the rating agency does, because nobody else has that information.
Right.
In a completely perfect world. In reality, what do we see? There is enough leakage, so the market has already discounted it. In fact, two things happen. Sometimes once the rating agency announces it, there is some discounting that still happens post the initial discounting that already happened. There's a little bit of post discounting that also happens. Sometimes we actually see that there is a change that's announced. The market completely ignores it.
Yes.
The market is actually not ignoring it. And we've done some work. If you go back and look at data over the plus minus 5 day, T minus 5 to T plus 5 window, and then extend that, you will see that in most cases in the T minus 5 to T minus 3, T minus 2 window, the market is already accounting for it. Right. So when there is this question is the entire thing getting accounted or part of it getting accounted? But so to that extent, market does discount. Are the markets perfect to discount everything? No, obviously not, because there are newer things that are happening. So it works both ways.
Thank you very much, sir. This question came into my mind because means 1 or 2 years back, a few people sitting in the administration at a very high position in the administration, and they suddenly left the administrative post and went to the Chicago University. But before going that, they asked the press. Press asked them a question: why market is moving up when the economy is going down? So they asked into the press. They made it very amply clear that if you get the answer, please call us. We'll come back from the Chicago to join your community. So that's why.
There are various reasons, and to that we can keep on talking about that, but that's a completely different argument. And I take your point. I take your point, and nobody really has an answer. But I think there are opinions on both sides, and therefore there is that. But when it's happening,
Right.
see, on one hand, when it's happening, you look at the story even today. If you look, I mean, I'm not talking about a 1 day, but if you look at the last 1 year, the last 1 year's market data, the market has outperformed by about 20%. The market return in 1 year has been on an average about 20%. From the index from just around 50,000 has moved to around 60,000 thereabouts.
Right.
A little bit up and down, but about that's a 20% increase.
Correct.
Yet, if you look at the real economy, and I'm not even taking my own position or my views and all of that, if you take the data that is publicly available on every single economic parameter, be it growth, be it whatever, trade, there is a negative. The slope is, well, not a negative value, but the slope is negative, and essentially here we've gone down. So it is actually very difficult to rationalize that if your economic parameters are not going up, and actually going down, not even holding constant, but going down, what is propelling the markets to move up, which also is happening. The market is moving at its own speed of 20%, yet this is kind of coming down. So there is some story that is kind of happening, which I don't think anybody has figured out per se.
Thank you very much, sir. Thank you.
Okay. Okay, let me just quickly complete this, because then we can take a break in 15 minutes, and then we can, I'll be around, so we can still continue discussing any other observations, and then we can do derivatives after that. Okay. Okay. What happened there?
Sir, it is visible.
Because on one screen I can see, the other screen I can't see it. Okay, if it's visible, then it's fine. Thanks.
It has not yet come in full screen, sir, actually.
No, I'm so it's on there. So obviously. No, that is not the screen. I mean, okay. Just 1 second. So which means. Okay. Now it will come. Now it is come, right? Full screen?
Yes,
Yeah,
sir.
now it's on full screen. Okay.
Yes.
So these are some of the simple terminology. So what happens is that if it's an investment asset, effectively for no arbitrage, the forward price has to be equal to the current spot into the future value to the bottom RT. Why? Because if the other two scenarios happen, then you can obviously create an arbitrage, and that cannot be justified. So you can't have an arbitrage condition, and therefore, obviously the only way this will adjust is essentially S not into the bottom RT. Okay. Now these are two simple examples that I've done, and I'm going to skip this in the interest of time. This is basically just showing that how the first two that I'm claiming will actually be implemented and can actually be activated, and therefore you will kind of do that. The only point I will make in this example is that, where you start becomes relevant and important. For example, in the first case, I start with borrowing money and buying. If I already had the asset, then that would I mean, you can say, okay, you have an asset, keep that, borrow money and do it. That's fine. But I'm saying if I already had the asset, with that asset I cannot create an arbitrage opportunity. I can create an arbitrage opportunity by borrowing money out there. Whereas in the second case, if I did not have the asset, or if I could not borrow the asset in the market, I cannot create an arbitrage opportunity. So the arbitrage opportunity exists, but also it depends on where I start from. That also becomes important in the whole scheme of things. Okay, now you could also have known income. So this can be on two counts. So this could be a dividend paying stocks, paying dividend, and therefore the assumption in that context are bonds. And the assumption in that context is I know the income that will happen during the life of the contract. So what happens outside the life of the contract doesn't matter. It is the value within the life of the contract. That is because for any additional payment that happens during the life of the contract, the underlying asset is adjusted downwards in a non-market manner. The thing is, the important argument is a non-market manner. If it goes down, if the price goes down because of a market effect, we are perfectly fine with it. But here, the payment of the dividend or the payment of the income creates a non-market movement, and that is what we want to avoid. We cannot have that. Now, the payment can happen at any point during the life of the contract. So what we do is that, I mean, so it kind of stems from the dividend payment argument, and we kind of extend the dividend payment argument out here. So if you think of a perfect market story and a company pays dividend, remember the stock price should drop by the dividend amount. So that is what we kind of use in a process. So basically what we are saying is that we know how much the dividend will be at a future point in time, and at that point, because the dividend, the market will drop by a certain amount, the dividend amount. So therefore, if you take the present value of the dividend and subtract it from it today, the market should drop by the present value of the dividend amount and then become effectively dividend free, hypothetically, so much so that the actual price in the asset is moving from the inclusive of the dividend to the dividend payment day. Only there is a payment drop. The other hypothetical process that we have created is dividend free, moves on its own in a similar manner. And on the day of the dividend payment or after the dividend payment on the first one, the two processes merge exactly. So that is the basic underlying framework under which it is kind of done. So I, in a sense, is nothing but I have written the present value of all the income from whichever source. And this is because again the basic argument of a forward price is I price it, so my asset is priced as a function of all future values, the future value of all the assets, the future value of all cash flows. Now, the future value of the cash flows, these incomes are not going to come to me even if I want it, and hence I kind of subtract it. Now, obviously, if, the other one is more with respect to dividend yield, currency processes and all, where I have an income, but it is more as a continuous function, and in which case it becomes e to the power of r minus q, where q is the average yield. So that is how it would kind of be factored in. As I said, for the index, it is basically q is the dividend yield, and therefore it kind of gets adjusted. The average dividend yield gets adjusted. Obviously, similarly out here, if you have the index, this will happen because if the other two happens, if it's greater than or less than, you will again have an arbitrage contract that will kind of get created, which cannot be justified, which cannot be set up, and hence this has to kind of hold. The same thing with currencies. Treat currencies as a dividend paying or an income generating, a continuous income generating asset, and RF is the foreign interest rate, RD is the domestic interest rate. So you actually take this. The only thing that you have to be careful about out here is how you write S naught. So I'm basically writing S naught as, so what do you define as, see, if you have, the question is like this, if you have rupee as one of the underlying, then your domestic currency is rupee and the rupee rate is the domestic rate. It is easy to understand. However, if you have, let's say, dollar and euro as the two currencies that you are working on, what would be your domestic rate and what would be your foreign rate? Or in other words, what would be a domestic currency and what would be a foreign currency? Now, I'm just using this simple conventional definition that it is number of units of the cheaper currency per unit of the more expensive currency. And the cheaper currency will be taken as the domestic currency, the more expensive currency will be taken as the foreign currency. that would mean that, my S0 has to be written in that manner, and my RD and RF are kind of functions of the way S0 is written. So it's like, if you take dollar rupee kind of thing, we are saying $1 is equal to, let's say 75 rupees. And therefore, the domestic rate, the Indian domestic rate is a rupee rate, the foreign rate is a US dollar rate. But you could have it the other way around, and if you were standing in New York, you could argue 1 rupee is 1 by 75 of a dollar. That is also perfectly fine as an exchange rate, but then you would essentially write your RD as a US rate and RF as the foreign rate. That's the only thing one has to be careful about. Now, I highlighted the investment commodities. You could also have a storage cost in the investment commodities. It is nothing but a cost. So simply add it to the thing. So, your R essentially becomes R plus U, or S0 becomes S0 plus U, where capital U is essentially nothing but the present value of the storage cost. So like if you buy oil and keep it, the storage cost has to be accounted for, and then the arbitrage argument has to kind of take care of the storage cost as well. However, the only change that comes out here is with respect to the consumption commodities. Consumption commodities usually provide no income, but can typically be exposed to huge significant storage costs. And thus the same arbitrage strategy cannot be used out here, because many times individuals and companies are very reluctant to sell commodities that they store in inventory for future usage. Hence, for the consumption commodity, the equality changes to less than equal to. The equation should remain the same, but in the investment commodity, you had it be equal to. Please remember that if it's a consumption commodity, the equation changes to less than equal to. In that context, we have now, but there's also a convenience in the argument. So basically, the point is that if you have the physical asset, that kind of enables the producer to kind of, so it's like, if you are a coal plant, you would want to keep coal as an inventory. If you're a power plant, a thermal power plant, you would want to keep coal as an inventory, because that will help you run the power plant. The cost of shutting down a power plant in the absence of coal is very high. So even though the coal is right as inventory and blocked asset for you, it might still be more useful to you. So the benefits from holding the physical asset are referred to as convenience yield, that is provided by the commodity. So if the convenience yield will then be, the forward price will have to be adjusted for the convenience yield, because that is the additional benefit that you get, which is known, and that has to be equal to the spot plus the storage cost and all of that. So if you look at that, and if it is in constant proportion, all that I've done is I've done some multiplier, you the power of YT on one side and it's to the power of R plus U times T on the other side. So I can take it to the other side and write it down as R plus U minus Y. It's just simple algebra that I've kind of applied out there. This is why convenience yield is there, so let's go through. Finally, there is a little bit in terms of cost of carry. The cost of carry is obviously that storage cost plus interest cost less income earned. So essentially, for an investment asset, the cost of the forward price will just be nothing but S0 to the power of CT, which is RT and whatever else, R plus UT and all of that. For a consumption asset, it has to be less than the same story, except that all of it put together is what I'm calling as the cost of carry. So cost of carry includes the interest rate, the storage costs, the convenience yield, whatever else will kind of come in. Convenience yield does not show, because convenience yield is taken separately, explicitly, as you can see in the last one. So it will essentially be e to the power S0 e to the power of C minus Y times T. Okay, literally one sentence, two things. When you enter into a contract, on the first day, the value of the contract has to be 0. Subsequently, it can have a positive or negative value. Theoretically, it can continue to have a 0 value, but that's very unlikely. But it can have a positive or a negative value. The reason why it is 0 value on the first day is because of this argument. It is equal to the investment asset is exactly equal to the future value. Now, obviously, if you have it different, there is going to be an arbitrage opportunity. Because if there are two prices showing up on that day, what will happen is you can buy on one, sell on the other, and therefore you can create a guaranteed profit or arbitrage. Arbitrage cannot be created. You cannot create a strategy which will kind of guarantee you an arbitrage. So therefore, on the first day, the value of the contract has to be 0. Subsequently, as the contract matures, or technically as we call as the contract seasons, which is also based on the fact new information comes in. Therefore, the contract will actually have a certain value because the profit. What is the value? The value is basically the original settlement price that was set up, adjusted against, if I were to enter into a new contract today, maturity on the same day, what would be the settlement price? So the difference between these two settlement prices essentially become nothing but the value of the contract in that sense. Okay. Another forward, long forward, short forward. Obviously, if you have an investment, sorry, if you have an income, you will adjust for the income in that manner. So that's kind of the thing out there. And similarly, the futures price and the expected futures price will essentially be this. So what can show that F naught, obviously I do not know the future value as S naught, but obviously it's expected value of ST into e to the power of RT minus R minus K times T. So that's what your forward value is, the rate of return. And then that can kind of show me whether if there is a systematic risk, K is equal to R, and therefore F naught is an unbiased estimate. If it is not, we have a positive systematic risk or a negative systematic risk, as the case may be. So this is the last step thing I want to show, and then we'll stop with that. So while I did argue and I did take that forward and futures are the same, except that they're only a trading platform difference, which is correct. Therefore, if they're the same, their prices should also be the same, which is fine. However, if the interest rates are uncertain, so in all of this, we have taken interest rates to be certain. We know the interest rate, and therefore that argument will hold. The certainty of interest rate will take care of that. However, when interest rates are uncertain, in theory, there is a small difference in the forward and the futures price. So a strong positive correlation between interest rates and asset price would imply that the futures is slightly higher than the forward price, and a strong negative correlation implies the reverse. This is because of the settlement and the trading process that happens, and because of the settlement argument. Because if there is a strong positive correlation, the settlement is the benefit is settled, the benefit is realized upfront. Whereas if there is a negative correlation, which means the change will happen at a later point in time, the benefit is typically expected to be kind of accounted for so therefore you would want to delay it as far as possible, and therefore and remember, the settlement in a forward contract, the net settlement is still the same, but the settlement in the forward contract is kind of backloaded. The settlement in the futures contract, because of daily mark to market, is kind of front loaded, and that is what the difference kind of comes in there. Now, if the contract size is small, this difference will not really show up much. But if the contract size is large, it's a 5-year contract or something like that, 10-year contract, then these differences will start showing up in a major manner. Okay. Okay. Let me kind of stop this session, this part of the session with this. Again, I'll open it up. Any observations, comments, questions? Otherwise, we'll take a break. I know there is a scheduled break. We'll take a 15-minute break, and then we will talk about the options part in the next part.
Okay. Thank you, sir. Thank you. I guess, sir, a break is desirable because you also need some rest on your vocal cord. So,
anybody have any observations or questions?
Yeah, participants, if you have any observation or question for Professor Basu, you can go ahead. We can have 1 or 2 short questions.
Okay.
Sir, can I ask a little question?
Please go ahead.
Sir, is there any way inflation is being also considered into this valuations?
Inflation gets considered in the valuation through your interest rate.
Okay. That is the reflector of that.
Yeah.
Okay, thanks.
Okay. So let's take a quick break. I'll just go and... Yeah, sorry, somebody was saying something.
Yeah. Okay, sir. Let us take the break.
I'll grab myself a coffee. I'll be back, and this will be open.
Sure. Sir, we end this session here because the attendance is taken by Google Meet platform on the basis of every session wise. So we end this meeting. We will, all of you please
All of you join the meeting? Okay, so I'll go and grab a coffee and I'll come back in 10 minutes and join again. Okay, thank you.
So next time I meet you, I will offer you the coffee, which will be
Sure.
okay, sir. Thank you.